Hi, thanks for joining this session. My name is Avinash Luthria, and this session is hosted by NISM. Quickly about myself, some of the details on the screen. The most relevant point being that I have been recommending market cap weighted passive index funds, and you'll understand what that is during this session, like Nifty 50, right from my first client. This was somewhat radical back in 2018 with my first, when I was taking on my initial clients. Now it's a little less radical, but still quite uncommon. And I continue to only recommend that I never recommend any active mutual funds. And in this session today, we'll discuss some of that thought process. About NISM, which is hosting this webinar and organizing this webinar. NISM that's the National Institute of Securities Markets, is a public trust established in 2006 by the Securities and Exchange Board of India, SEBI. SEBI is the regulator of the securities markets in India. uh, the institute, that is NISM, carries out a capacity building activities at various levels aimed at enhancing the quality standards in security markets. As with all NISM webinars of this kind, questions will be taken at the end, probably the last 10 minutes. All participants will receive a certificate, and the recording at some point will be put up on NISM's YouTube channel. The objective of this webinar is that largely you get to hear of active funds to all mutual fund, mostly all mutual fund advertisements, and most articles also about mutual funds in newspapers, etc. So to a very, very tiny extent, this webinar is trying to give you the opposite point of view, that low fee passive index funds are good for you. After this session, it's up to you to figure out, do you want to know more about it? You can research more, or are you convinced? Uh, you're the jury on that. This is an old advertisement, print advertisement by a US active fund house from maybe 45 plus years back. Uh, Index funds are not popular in terms of being liked. And that's one of the reasons for this session. It's useful to there are a lot of myths about index funds, false statements, and I've done a blog post that you see here, which on my website, which lists 25 such false statements or myths about passive index funds and goes through them very, very briefly. But that list of false statements against passive index funds is very large. This is just 25. There are hundreds of such false statements. This is one somewhat famous false statement by a sell-side equity research house in outside of India. And this is just an example how there are just n number of such statements, passive index funds. I realize that it doesn't make sense to structure this presentation uh, based on trying to debunk all these various false statements. It would be simpler to just the approach that I've listed here is simpler to just list 20 reasons to invest in passive index funds. The way I'm doing it in this session is the first 10 reasons are very simple. People who know more about index funds will probably find that a little boring. You can think of it like the first gear in the car. And the next 10 reasons are a little less simple. They're not complex reasons, just little less simple. Like the second gear of the car. Nothing gets into third, fourth, fifth gears on this particular webinar. There's no advanced material. I am forced to oversimplify with various sentences because otherwise it would get difficult for me to frame a sentence covering all the exceptions to the rule to that one sentence. And it will get extremely boring for you to listen to it with all those exceptions. So just for convenience, every sentence is slightly oversimplified. So it may not be 100% correct, but it's getting the spirit of the point across. And this session focuses only on equity funds. What you see here on the right side of your screen is what you're probably very familiar with, or if you're all very familiar with, which is one example of an active large cap fund. Doesn't matter which fund house, it's just one example. And this is some of the holdings it has, and these are the percentages of these companies these 5 companies that it holds. It mentions that this fund is benchmarked to the Nifty 100 index. And on the left, in the middle or the left of the screen, you see what the Nifty 100 index or Nifty 100 index fund, which is effectively the same thing, holds. Somewhat similar percentages here and there. The fund manager has chosen, for example, Bharti Airtel, they want a little more. Infosys, they want a little less than what the index is saying. So the fund managers using their thought process to pick a slightly different weight from what the index has, and we'll talk about how the index comes up with these weights in a little while soon. So what is an index fund? Again, oversimplified. The golden rule of investing is to diversify as broadly as possible and minimize investment costs, so fees, costs, all kinds of costs. The index fund aims to do exactly that: maximize diversification and minimize fees and costs. Often, sometimes these two objectives are in conflict, so the index fund has to find some trade off between maximizing diversification and minimizing fees and costs. Theoretically, the way an index fund would do it if it had no constraints was to buy, say, I'm just giving an example of 0.02% of every company in the world. So 0.02% of Amazon, 0.02% of Apple, 0.02% of HDFC Bank, every company like that. The same percentage of every company. However, for Indian index funds, RBI won't allow that construction as of June due to certain RBI rules. So how Indian index funds do it is the same money they could have used to buy 0.02% of every company in the world. They're just saying we'll buy 1% of every company in India, which is listed in India. So 1% of HDFC Bank, of the shares of HDFC Bank, 1% of the shares of Reliance, 1% of the shares of Infosys, etc. Lastly, the last bullet point is that in practice, index funds may choose to ignore tiny companies or tiny stocks. How they define tiny company or stocks could vary from one index fund to the other, and we'll talk maybe a little bit about this later. So they may only hold the top, say, 500 companies, top 100 companies, and we'll talk about what that is. So as I mentioned, an index fund holding 1% of every company in India. For example, here, let's take it's holding 1% of the top 100 companies in the Nifty 100, a Nifty 100 index. It's holding 1% of all the top 100 companies in India. If you hold 1% of HDFC Bank and 1% of Swiggy, you would have put much more money into HDFC Bank in rupee terms than you would have put into Swiggy, a smaller company. So what you get finally is this kind of a pattern based on how big these companies are, which essentially is exactly identical to the market capitalization of these companies. And we'll talk about a nuance later. So it's holding 1% of each of these companies, but what you get in terms of rupees allocated is this pattern, which matches the market capitalization of these companies. And there's a mathematical proof essentially that if you were to invest globally by this method, it's the most efficient way, the way that minimizes risk and maximizes the possibility of return. So there's a mathematical proof which we won't get into, is an advanced topic. So it's not relevant for this webinar today. I'll just cover off some simple terminology before we start so that we're all on the same page. Now, mutual funds, they are just a subset of mutual funds. In this webinar, when I talk about index funds or mutual funds, I'm referring to the direct plan, which is a zero commission plan, not the regular plan. That's by default. And SEBI's terminology, which is very logical for the regulator, is to have two categories of funds. One is active funds, where the smallest active fund is subject to a fee limit of 2.25%. It cannot charge more than that. Actually, the fund can choose to charge less than that, but not more than that. And a second category that SEBI has called index funds, where the fee limit is 1%. Funds can charge less than that, but they cannot charge more than that. Then there's this third bucket of factor funds like momentum, equal weight, etc., where SEBI says, I'm going to move them into the index fund bucket. So they're limited to 1% fees because there's no high salaries to be paid to the managers. So they'll fit in the 1% fee bucket. So SEBI has two buckets. But the conceptual terminology from our point of view is that how finance theory would look at it is that these factor funds like momentum, equal weight are somewhere in between active and passive. they're not purely passive, they're not market cap weighted passive index funds. So here in this presentation, when I'm talking of passive index funds, I'm talking about something like Nifty 50 and others, which we'll talk about, not these hybrid, I mean, these factor funds, which are halfway between active and passive from a conceptual point of view. This is an example of about the six relevant index funds for Indian domestic investors, starting with the broadest, which actually is the most representative of what an index fund is. Remember in the earlier slide, the idea was to buy all companies. So the BSE 1000 index fund is most sounding like that. Then it doesn't matter whether it's BSE or Nifty, it's essentially very similar in India. Then you have only the top 750 companies, the top 500, top 100, top 50s, and the Sensex top 30. I mean, it's called Sensex, but it means top 30 essentially. These are the main index funds for resident Indian investors or Indian investors essentially. We'll talk a little bit about them later. And it really doesn't matter too much which of these you pick. I mean, they're all pretty good options, really. You hear about index funds versus ETFs. This webinar is focused on index funds. Nothing wrong with ETFs, very good products. But for simplicity, this webinar focuses on index funds because it's simpler for most people to invest in. Even index funds, non-ETF index funds can be invested in demat mode and non-demat mode. This webinar assumes you're investing for simplicity in non-demat mode. There's nothing wrong with demat mode, but it's just an assumption for this webinar that you're investing in what's called statement of account format. For example, going to the mutual fund house website and buying it. That's what this statement of account format is. And largely, I'm assuming that when you have a choice between growth and what used to be called dividend, now called IDCW, you're picking growth. This is a very simple point, so I won't get into it on this webinar. I'll assume that you already know this bit. This is the Nifty 50 index fund, which is the most common index fund in India, the oldest, the one with the highest AUM. Whether you include the EPA, the Employee Provident Fund Organization that we'll talk about in a little while or not, it's still the largest category, subcategory within index funds. These are the weights slightly different from the Nifty 100 that you saw earlier. And by default, when I'm talking about index funds, I'm referring to this, but it doesn't have to be Nifty 50. You can always invest in something else. The Nifty 50 is what I like a lot, but that's just my personal preference, and I'll talk about why. Let's come into the first reason now. And we'll start with the simplest reasons first, just to get started. Sophisticated investors use index funds, passive index funds. One example is the Employee Provident Fund Organization, which uses Nifty 50 and Sensex 30. Warren Buffett has written instructions that when he dies, all of his wife's equity money, which is 90% of her wealth, goes into the Vanguard S&P 500 index fund. So it's not thoughts, it's what he's dictated for his wife. That's his level of confidence in it. And knowledgeable investors of clients or clients of people like myself, and even people who are not clients of any RIAs, use passive index funds in India. Actually, I would say they tend to use passive index funds more than they use active funds. The second reason is it's very easy to pick a category. I listed about 6 different options within passive index funds in India. There's a 7th, but I'll ignore it for this webinar. It's not relevant to resident Indians much. And the EPFO has made our life a little easier to start with saying, the EPFO is picking Nifty 50 and Sensex 30. It's a very good starting point for you to say, okay, they have picked this. Let me start my evaluation with these 2 options. You can always pick outside of this, but it's a very easy starting point. They made your life easy. And of that, Nifty 50 is the oldest mutual fund category in India. And because of the history of it, the most fund houses offer the maximum number of, within index funds, the maximum number of fund houses offering that subcategory is in Nifty 50. So That adds a certain benefit that we'll talk about later, and it becomes a very easy choice for many people. But equally good, Sensex is an equally good choice, and Nifty 500, others are extremely good choices also. The third reason is that it's very easy to select a fund house, particularly within Nifty 50 and Sensex. There are n number of fund houses offering this product, all identical, very hard to go wrong in terms of whichever you pick. The fees are identical here or there, slight difference. Even if you try to go wrong and picking the wrong fund house in Nifty 50 is very hard. Somewhat similar to for Sensex, but um, I mean, equally good choices exist for various fund houses. You want to pick any of these, I mean, it's a good choice. Or even those that are not mentioned on the slide. They're all equally good. A very similar looking slide, but what it says is that if you are investing in Nifty 50 or Sensex, you want two fund houses. You're worried, what if, these fund houses website is down someday? Pick two. If you want three because you think too much of money is in two of them, pick any of them as a third. It's very easy to just, these are like bricks. You can just keep adding them as bricks or building blocks. You don't need an advisor to tell you, Nifty 50 is now good or Nifty 100 is now become better. It's all irrelevant. You don't need an advisor to invest in Nifty 50 or any of these, even Nifty 100 or any of these things. You just go to the fund house website and I'll show you about it, or go to mfcentral.com, all equally good options. There are some small positives and negatives between them. The first, just one example, this is just an example. It doesn't mean that you should only use HDFC, but just to show you, this is the website of HDFC Fund, HDFC Mutual Fund. That is different from HDFC Bank. That's what I wanted to highlight. And I've zoomed in here onto the website address. You see hdfcfund.com, right? That is different from HDFC Bank. So if you want to buy direct line, you go to the fund house website. Many of these fund houses also have the option that if you're a first-time investor, they do your KYC online, etc. That option may not be available with this site, MF Central, but the good thing about it is that you can invest in every single fund house in India, or redeem what you already have, or switch what you already have through this site, mfcentral.com. It's an excellent site and I use it. Starting to get to the little more complicated points, there's a strange pattern where, particularly you see it with funds that invest in small cap, etc. The fund returns might have been decent, but sometimes the investors' returns are worse than that because they kept jumping. And you see it maybe not in the mutual fund world, more in the PMS world, where people keep jumping from one portfolio management service to another. And it's possible mathematically that the investors' returns by jumping around could be possibly worse than the fund's returns over the time because they just jumped around so much. Could happen. And the way we all told that, you should keep tracking your funds. Has the manager changed? Is the manager doing well? Is he doing poorly? Those are all actually bad habits. Most of what we've been told about how to invest are really just propagating bad habits. One good thing about index funds is they push you in the opposite direction, not to track all this noise about who is the fund manager, what has he quit, has he been fired. All of that is completely irrelevant to your life. Try to try to have as much self-control. And when you're investing in a fund, think, can I stay invested for 10, 20, 30 years till I need this money? That's the litmus test that you need to pass to invest in a fund in the right way of investing. And index funds push you in that direction of saying, I can stay invested in this till I need this money 20 years from now. Another tricky bit is someday in our life, all of us might in the future face a 30-40% fall in the market. And when that happens, it's going to be hard for any of us, myself included, to not panic. And one way to, I've written articles saying that there is nothing guaranteeing that equity is safe in the long term. Equity is risky even over a 10, 20, 30 or 40-year horizon. Once you know that, once a crash happens, once you understand the truth about it, it's natural to panic. because you have no idea how long it's going to take to recover. Will it ever recover? And one way not to panic is try to be dispassionate or as detached as you can from your portfolio. The fact that your portfolio has fallen enough to lose two apartments or your lost value equal to two apartments that you live in obviously plays on all our minds. And the way to handle that is try to be as detached from it, not tracking it. Index funds again push you in the direction of not tracking it and trying pushes you in the direction not feeling that fear by trying to create some detachment between you and your portfolio. Just looking at the headlines that a business newspaper is enough to track it. You see the Sensex, Nifty, etc. here. That's enough. This is like saying, instead of tracking your portfolio, which is like smoking a pack of cigarettes a day, go to this, which is smoking one cigarette a day, and then gradually try not to do even this. It's all a bad habit of tracking. Try to track as little as you can. I know it's human nature. Even I track to some extent, but you can just track maybe your net worth once a year. That's actually good enough. So let's say you've learned from index funds not to run all over the place picking the hot fund, the hot sector. That same learning can now be applied to not do other exciting things like tactical asset allocation, moving your asset allocation to 0% when you think the market is expensive, moving it to 100% when you think the market is cheap. All that is usually wrong, and we all go wrong on that. Learn from index funds to develop self control and apply it to other aspects of investing like asset allocation. Index funds save your time. You don't have to waste time tracking whether the fund manager has changed his job or not and all that, how he's doing. Use that time to address more important questions like, are you saving enough for retirement? These are much more important questions. All that noise and distraction about is this the right large cap fund versus that large cap fund is all just distracting from looking at the more important questions. And finally, for the last point for this simple section of the presentation, all that you hear on newspapers, television, etc., is only talking about active funds. So you think that is normal. But finance theory and the good finance textbooks all say the exact opposite, that index funds are normal and active funds are an aberration that typically people who know less about investing pick active funds. This is a textbook that I had when I was in doing my MBA, earlier edition of this book. And at the end of this book, you have a chapter called What We Know and What We Don't Know in Finance. There are some things in finance which are quite complex and we still don't know. But index funds is one of the easy topics that we do understand. Index funds and active funds. There's been 50 plus years of research on this topic. And what I've highlighted there is the conclusion that on the topic of using index funds across the world, not just in India, there is complete widespread agreement. There is not a single finance Nobel Prize winner who says otherwise, and if they did, they would get laughed at, really. I mean, they may raise some little nuance here and there about some weird nuance, but not disputing the main aspect of it. Let's switch now to the second half of the presentation, the second gear. I'll probably move a little faster on this one. Some simple terminology. The Nifty and Sensex values you see there in the newspaper are what's called the price return index. There is a different index called the total return index, which includes the benefit of dividends. Whether you hold the shares or you hold an active mutual fund or you hold an index fund, all of them get the benefit of the dividends that companies are paying. What you see in the newspaper is without that benefit. But for any fund, or if you're holding the shares or the index fund or the active fund, obviously it's getting the benefit of dividends. So the right comparison, which all of them do, is to what's called the total return index. This is a snapshot of the Nifty 50 index fund fact sheet from end of April. And you see it has a price return and 1.5% higher because of the dividend 1 year data that you see. While we're on this slide, it's also worth noting that okay, I think Zoom is mentioning that my internet connection is a little slow. I'll just talk a little slower to compensate and I'll wait for someone from NISM to tell me if there's a problem. So since inception, Since the 1,000 value of Nifty, it's given a 11.4% price return. But the last 5 years have been close to 20%. So it's made people very adventurous and propagated the belief that you can have a 100% equity portfolio and it's fine and it's okay. And many people are doing that. But it shows you how much of an aberration the last 5 years have been. And we shouldn't treat that as the normal. Another bit of terminology is that what we discussed so far was a market capitalization, but for certain technical reasons, index funds are actually constructed using what's called free float market capitalization. The way to see it is Reliance Industries has a bigger market capitalization than HDFC Bank, but the promoters of Reliance hold half of Reliance, 50% roughly. And HDFC Bank has no promoters, so all 100% is available to public like us to index fund to buy. So index funds weighted based on how much is available to the public to buy. This is just a technical reason why index funds do it. We won't get into the reason why on this presentation, but that's what world over index funds do for certain optimization reasons. It doesn't change things too much, but it's just an optimization step that where it deviates a little bit from the, to be more practically efficient. Lastly, you hear about terms like tracking error and tracking difference. Good terms to understand and know, but at least for investing in Nifty 50 and Sensex, and more so Nifty 50, not really relevant. There's no need to check it. There's no need to track it. There's no need to evaluate it before investing. You can largely ignore these for these two subcategories of index funds. It becomes maybe a little more relevant for some other subcategories, but not for these two. Moving on to the more complex reasons now. Even if you have 100 crores to invest, you are a very small investor who cannot really negotiate with mutual funds for fees and all of that. So do use what is on your side. And there are two things on your side. One is SEBI as an arm of the government trying to help you. And the second is capitalism, which we'll talk about later, trying to help you. So use SEBI limiting the fees of index funds to help you. You see a chart here that's, as I said earlier, SEBI limits active fund, the smallest active funds fees to 2.25% per year of the assets under management of the fund. Funds can obviously choose to charge less than this, and for larger funds, SEBI has even a lower threshold, but let's not get into that complexity. For index funds, SEBI has a lower threshold of 1% is the limit that SEBI allows. Funds would charge less than this often, but SEBI is already dictating that you cannot charge index fund investors more than 1%. So use this to your benefit. For this slide, I'm just focusing on what's highlighted in the red rectangle, which is the left side of your screen. We'll come back to the right side of the screen in a subsequent slide. So this is in percentage terms, but the human mind is not that good at grasping it in percentage terms. So I'm showing it here in rupee terms. So you have 1 crore rupee portfolio. SEBI is saying for a small active fund, 2.25 lakh, they deduct from your investment year to pay the fund house. And for index fund, SEBI says that for small active funds, for a 1 crore 1 crore portfolio, let's say, SEBI says that the fund cannot charge more than 2.25 lakhs. And for index fund, SEBI says you cannot charge more than 1 lakh. So use this to your advantage. And we'll come back to the right hand side of the slide later. Further, there's a bug in the human brain which doesn't realize that a fee of 1% per annum in 2 years is actually a total of 2%. And over 10 years is a total, 1% over 10 years is a total of 10%. So let's see what this means. You see the same old slide from earlier, I just changed the axis that over 1 year, the difference between the active fund and the index fund fees is 1.25 lakhs in this case on the maximum fees that SEBI allows. If you fast forward to a total of 2 years, the total fees now is 2 years. So that means it's 2.5 lakh rupee gap between the maximum that SEBI allows. You fast forward to 10 years, these amounts start becoming bigger and bigger. At some point, you can afford, with the saving on this, you can afford to probably buy a car. At some point, long enough, you can probably afford to buy a house with the saving you've just made on these fees. I'm just checking on network, sorry, before moving forward. Okay. Active fund returns are not better than index fund returns. And if you go on an apples to apples comparison, they are less than index fund returns. And we'll see what I mean by apples to apples in a little while's time. The first proof of that was the Standard and Poor's Indices versus Active Funds India reports, PIVA India report. So this is specific to India. Standard and Poor's puts this out. They've been putting it out since 2010, and it's always been saying the same thing, that active funds are not able to beat index funds. They use a global methodology, so that it wasn't really designed for India, but they use a standard global methodology across all countries and supply it to India. The latest report for 2014 end shows that 93% of active funds for the 5 years ended December 2014 were not able to beat the index. Why I'm focusing on 5 years is SEBI recategorized active funds in middle of 2018. So 5 years data is the cleanest data. And large cap is the cleanest category because other categories, there are not enough funds to draw a statistically valid inference. So this is what the SPIVA report shows. But we have something even, we have another data point now, which a couple of months back, SEBI insisted that all mutual fund houses publish what's called the information ratio. And the same data is put up on the mutual fund house website. Somewhere you'll find it, but easier to find it on the AMFI website, where it's compiled for all fund houses. To explain okay, let me just go to the next slide, then I'll explain what the information ratio is. So if you go to the AMFI site, this is a particular day when I took the data. You'll find maybe a little different if you go on a particular day. You can pick the date also on the AMFI site. So you can go back to this particular date that I took the data. You see, I have, the AMFI site cuts off the data on the horizontal side, but you can download it on an Excel sheet. There's a link to download it. So the data is all available to you. I have sorted it based on what's visible on the screen on the regular plan, though the direct plan is more relevant. And here you see, out of this 25 odd large cap funds, the 5 year data shows that there is a threshold of 0.5 being a good information ratio. What this means is, for SEBI saying that, or not just SEBI, but this is the concept of the information ratio. It says that it may be possible to earn extra returns by putting a lot of money into mid caps and small caps by taking more risk. And on the average, not always, but on the average, the fund might get better returns. But that's not really exciting if you're taking more risk. Let's compare it on a apples and apples basis with the same amount of risk. So what the information ratio says is, for every 1 extra % of risk, are you at least as a fund manager able to generate 0.5% of extra return per annum? And based on that benchmark, for at least the regular plans that you can see on the screen, only 2 out of 25 did well. Maybe if you went to direct plans, maybe it would be 3 out of 25. And it's the same pattern. So just to highlight, you can see the third option here, the third fund here, it beat the benchmark, but this metric is saying that that was just beating it by taking more risks, so not giving you credit for that. The same pattern you find in mid caps and small caps. You'll find the same pattern if you go to the AMFI site and look at the information ratio for mid caps and small caps. So it's just a myth that, in mid caps and small caps, it's easy to beat the index. It's extremely hard. And later we'll talk about why. Obvious thought that will come to your mind from the previous slide is, why not just, invest in those two funds which did well for the last 5 years, or the 2, 3 funds which did well for the last 5 years. So Standard and Poor's put out an article with some data where they actually tested this. This is quite a while back. There are too many numbers on the screen, but I'll highlight the key point here, which is that they found that the last 5 years of data of which fund did well, if you invested in that, it gives you no special advantage for the next 5 years to do well. It's completely random for all practical purposes. So which fund did well for the last 5 years tells you nothing about which fund will do well for the next 5 years. So that data is pretty much useless while trying to pick funds for the future. This number is basically saying that it's just quite random which fund does well for the next 5 years. So then what are we left with? We can't predict which fund will do well in the future. Then what do we do? What we can do is we control one variable as investors. We control fees, and that's what we should control. How we do that, coming back to the same slide, is SEBI has made our life easy by saying index funds can only charge 1%, or in this case, 1 lakh for a 1 crore portfolio. Use that to our benefit. That's what's in our control. Let's do that. Further, that's the current fees. We don't have the bandwidth to keep checking fees or keep checking every email about change of fees over the next 10, 20 years of our investment life or 30 years. So we want to know what are the fees going to be for the future, but we have no guarantee on that. The fees can change anywhere within that 1% that SEBI allowed. So Nifty 50, essentially competition between fund houses in a subcategory drives fees to a large extent. That is the primary driver. There could be other drivers, but this is the primary driver. And since Nifty 50 has the most number of fund houses competing, it's where capitalism helps us in controlling fees. So now I move to the right side of the slide. SEBI has put a limit of 1 lakh on the fees for this 1 crore portfolio, but Nifty 50 funds are typically at 0.2% fees, which is 20,000 rupees for every 1 crore invested. Some are a little more, some are a little less, but broadly, this is the typical. You might say, okay, how do I care? One index fund charges 20,000 rupees, other one's charging 40,000 rupees. How do I really care? As I explained earlier, once you fast forward to 10 years, 20 years, this 20,000 rupee difference between one index fund and another starts becoming in 10 years a 2 lakh rupee difference. So it starts making some difference to your life. And one more reason you may feel that, okay, what is 20,000, what is 2 lakhs? I don't care, because you may have a very large portfolio. So I've shown if you have a 10 crore rupee portfolio, I've just multiplied everything by 10. Uh, let's say one index fund charges 2 lakhs, another one charges 4 lakhs. You've saved 2 lakhs on a certain fund. I know you may say, but can I get better returns on the other one? But I'm saying focus on what you can control, which is fees. And here you find that if you've saved 2 lakhs in 1 year, you've saved 20 lakhs in 10 years, at some point, these numbers start becoming meaningful to your life. This is one of the most important reasons to me. This is my biggest reason for liking index funds. The meaning of it is that uh, I'll come back to why I'm making this statement, but index funds are charging me a 0.2% fees. If you gave me an active fund at 0% fees, obviously I love low fees, but if you give me an active fund that's even 0% fees, I won't take it. I won't invest in it. Even if you promise me for the next 30 years, the fees are 0%. And I'll explain why. Because I don't want randomness or bad luck or good luck. It could be good luck or bad luck either, and I'll show you what I mean. The S&P report for 2024 December, sorry, categorizes how these various large cap funds did over the last 10 years. So the top 25% of best performing funds, the next 25%, what it calls quartiles. This is the technical term for the top 25%, second 25%, third 25%. This is talking in terms of funds, but this exact same mathematics applies to people. So you can think of it as the top 25% lucky investors got the 14 something percent. The next got the 13 something percent. The next got the 12 something percent return per annum. This slide doesn't have the bottom unlucky 25%. So what I've done is I have back calculated it and I got an estimate of about 10%. So there's a wide variety of performance possible. But there's a caveat here. The caveat is that this was in a period of 10 years when market returns were quite good. Imagine a normal market environment, subtract 2% from this, and you imagine you're on the bottom unlucky set. Instead of 10%, you get 8%. Imagine that this was in a 10-year period when returns were poor. Now if you're on the bottom set, you might be at 4 or 6% returns. It starts making a difference. And to make it more tangible, this is just an illustration. These are not real numbers. This is just an illustration that if you're an index fund investor and your salary determines that you live in a 2-bedroom apartment, your investments also will drive you to stay in a two-bedroom apartment. On the other hand, let's take three active fund investors. Their salary determined that they could stay in a particular kind of two-bedroom apartment. One of them got lucky. He ended up being able to live in a three-bedroom apartment. Two got unlucky. That's what roughly the data shows. And they had to kind of live in a one-bedroom apartment. Including fees, this is worse than a coin toss odds. One-third chance of turning out well, two-third chance of working out badly. Why would anyone take these odds? Even if there were no fees, why take a coin toss odds? It's just adding unnecessary randomness to your life. This is a slightly mathematical point. You probably have to run it on an Excel sheet later after this call. Some of you may be very familiar with it. But delaying with mutual funds, you pay tax when you redeem. And with the index fund, hopefully you'll redeem 10, 20, 30 years later when you need the money badly, not till then. And by delaying taxation and not jumping around between funds, you can probably get something like a, just as an indicative basis, a 0.5% per annum extra return. This is just a random number I'm throwing out. It depends on your particular circumstances and how much you jump around. But 0.5% per annum extra over a long period of time is very, very valuable. And you can run it on an Excel sheet and you'll see that this small little benefit comes. Finally, why are active funds struggling to beat the index? The reason is that retail direct equity investors do poorly. On the average, there's no doubt about that. And active funds do better than retail direct equity investors. So it's better to be an active fund investor than to be a retail direct equity investor picking particular stocks that you like. But there is a apex predator here, which is founders or promoters. And the reason why they do better and hence forcing active fund managers to do a little worse is because, as I've written in this article in Business Standard, founders or promoters have a little more inside information than active fund managers have. This is a bit of a sensitive topic, so I'll be careful my words. You can read this article. Essentially, I'll just zoom into the right part of that article. It says that active funds on the average net of fees underperform the index because they have less inside information than promoters of companies. Yes, trading based on inside information is illegal, but it's not possible for the government to prevent all forms of inside information that might impact a stock 2 years later, 1 year later. It may be illegal to use that information, but it's very hard to for the government to prevent that really, or put in place mechanisms to prevent it. I'll jump to the Q&A section. I'll just leave you with a quote by Warren Buffett saying that Jack Bogle is a hero for creating the index fund. And I'll just go to the chat box to see what questions have come in and try to answer some of them. Someone's asked a question about what about index funds like Nifty Bank, like I guess, let's say Bank Nifty, etc. These sector-specific index funds are not really broad-based index funds like the ones I spoke about. The Bank Nifty was a specific reason for international investors. That's the history of it. Otherwise, there's really no reason to be investing in sector-specific index funds. Just again trying to be like an active investor, which is not required. Or big PSU, index fund, etc. All that's irrelevant. Someone's asked a question: should we go for ETFs rather than index funds as they have a low expense ratio? I think this person's also asking okay, I'll read the whole question. Should we go for ETFs rather than index funds as they have a low expense ratio with opportunity to buy at market price when there are market corrections? So there are two different questions here. I would agree to some extent with the first part of the question that yes, you may be able to get a lower fee with the ETF. So if you're a kind of little more sophisticated investor, you could, and you have a low cost broking account, you may be able to benefit from that. But for this presentation, I'm not focused on that because it's too complicated. The second part of the question, I would think that, you shouldn't be trying to time it and buy it at, when the market crashes in the middle of the day. I think don't get into that. That's not really the objective of investing. So don't get into that. What's your take on Nifty large mid cap 2000? Oh, sorry. What's your take on Nifty large mid cap 250 index? The reason I did not list that index in my set was that index, which put 50% in large cap and 50% in mid cap, not exactly my style of just going by market cap weightages. This is one of the strange cases where the name is a little confusing. If you know Nifty 500, the name is exactly what it is, Nifty BSE 1000, the name is exactly what it is. Nifty large mid cap 250, the name is not, it's a little confusing initially. Even when I heard it first time, I got a little confused because this fund puts half its money in large cap and half in mid cap. I feel there's no harm in it, but I don't want to complicate life by uh, picking something a little more exotic like that, which is trying to do something more. Someone asked, can we advise index funds for age group of 30 to 40? Index funds work for any age group. There's nothing about age group here. I'm just picking a mix of simple and difficult questions so that different kinds of audience get their questions answered. Someone's asked about smart beta or factor funds. As I mentioned, I do not like smart beta or factor funds. Broadly, what happens is that the fees may eventually land up higher than the simple plain vanilla index funds like Nifty 500 or Nifty 100. So I don't want to pay higher fees. I don't think the theory also, it's a very complicated topic, but the theory does not support, or the data does not support factor funds or smart beta. At least that's my reading of the data. Someone asked, what should you invest? How much should you invest in index funds? For me personally, or my clients' portfolios, the entire equity portfolio is in index funds, 100%. I mean, so let's say 50% of the client's portfolio is in equity, then that entire 50% is in index funds in that particular client's case. Index versus equal weighted index. An equal weighted index is just another kind of factor fund. Doesn't particularly interest me. Which index fund is good for beginners? Nifty 50 is what I have been recommending to every single client for their domestic portfolio. It's a good starting point. Nothing wrong about the others, but you can take this as a starting point as to evaluate at least as is that a product that you're interested in. Given that it's the largest category in India, it's a automatic starting point for evaluation. Somebody's asked, what's the difference between mutual funds and index funds? Mutual funds is just a broader term. Index funds are just one, some mutual funds are index funds, others are active funds. That's it. Someone's asked, please name the website or platform from where I can invest directly in mutual fund schemes without opening Demat account. Yeah, so all these, which is HDFC Mutual Funds website, hdfcfund.com, or you don't need a Demat account at all. Similarly, if you're already invested in mutual funds, MF Central does not require a Demat account of any kind. Someone's asked a theoretical question, what is the broad market index fund, Nifty 50 or 100 or 500? All of them are good. I think there are certain pros and cons. Each person has their own, subjective preferences. So I like Nifty 50. Someone else, other good RIs like Nifty 500. Some might like BSE 1000. All are good. It's just I'm very obsessed about fees, so I like Nifty 50. Also, my clients don't often renew the engagement. That's the way I've structured my engagement. So they may not come back for 3, 4, 5 years or even ever. And I want the peace of mind that if I have recommended a product, the fees will be competitive 10 years from now. So Nifty 50 gives me that small little peace of mind as a RIA, a registered investment advisor. Okay, someone's asked, if you buy index fund, isn't the money chasing the same stocks? Okay, I'll read the question. If all are buying index funds, means same stocks, does it not mean that large money chasing same stocks create artificial demand and inflate share price? No. I'll go back to the theory of the index fund where you're buying 1% of all shares. So if you're buying 1% of every company, how is it buying more one or less of the other? Yes, in practice, they are not buying some of the small companies, but there are certain technical challenges with small companies. For example, you cannot short uh, active investors cannot short the stocks beyond the top, say, 200 something companies. That makes their prices little less efficient or perfect. Uh, so, using only the top 100, 200, whatever companies is not a flaw in that sense in my worldview. Someone's asked about Nifty 250 versus 500. I'm not aware of a Nifty 250 full-fledged market cap weighted fund. I've only seen the large mid cap 250, which has equal split between the two. So I've not seen a full-fledged simple market cap weighted 250. So I'll skip that question. Someone's asked a question about FOMO. I think very valid. Even, I had some pain because I used to recommend Nifty 50. I felt bad, so my clients did not benefit from all the run up in mid cap and small caps that happened over the last 5 years. But I think some amount of, I had a reason for it, which I won't get into in this presentation, but basically my worry about in a big crash, what happens, etc. But I think we'll just have to control FOMO and, you know, looking at what our friends have done. Someone's asked about diversification internationally, important, but currently none of those funds are, for all practical purposes, taking money. There are some exceptions to that rule, but largely very difficult to do that today. There's no demat account required to invest in index funds. Index funds are just normal mutual funds. They're just different. I mean, X mutual fund versus Y mutual fund. That's it. There's nothing different about it. Good way to invest, SIP versus lump sum. I think SIPs are a very good way to invest. It controls our behavior, especially for equity funds. It controls our behavior, and we don't look at, let's wait for the election to be over, then I'll invest more. Or what about the US election? What about the war here, the war there? I think SIPs are very good way to invest and stagger the investment, particularly for people who have a salary. But even if you have a very large amount of money, you could stagger it through an SIP over a short period of time or appropriate period of time. Someone asked about returns of index funds. So remember that index funds are also, just like any equity fund, index funds are also risky. The index funds don't take away your risk of equity. They are risky. No one knows what the returns will be over 10 years, just like with an active fund. The returns could be less than inflation. The returns could even be negative. There are no guarantees at all with equity over 10, 20, 30 years. It's a risk everybody takes while investing in equity. It is a worthwhile risk for some portion of our portfolio, but it is a real risk, and we should not imagine that a greater time horizon or index funds in any way takes away that risk. Someone's asked a question about market efficiency. It's a slightly technical topic. Essentially, let me go back to the presentation and put it back. As a further reading kind of point, uh, there's William Sharpe, who's a Nobel Prize winner, who in 1991 wrote this brilliant article. It's probably the best article in all of investing in the last 50 plus years. This is the article, The Arithmetic of Active Management. The and it says that it's talking about active investors, not active funds, but active investors, a whole broader universe, which includes active funds, promoters, direct retail investors, etc. And it says that before cost, they will earn the same return as the index, and after cost, they will earn the lower return than the index. It's a mathematical proof of this point without any equations. So about market efficiency is relevant, but it doesn't. This argument is kind of simpler to understand if you go read this, and there is a connection to market efficiency, but this itself is fairly convincing enough, which is a brilliant article without any equations. Uh, Lastly, you see this bet that Warren Buffett had with a fund of hedge funds. One of the senior people of this hedge fund is now the finance minister of the US. Warren Buffett won this bet, betting that the index fund would beat this more sophisticated pool of money in hedge funds. For hedge funds, you can think of it as long short AIFs or category 3 AIFs, alternative investment funds in India, or even something like a PMS to some extent, but more strictly like a category 3 long short AIF. And Buffett won this bet that he said index funds will beat the active investors, and it did. Uh, that's what Buffett did. Now over to you to, if you'd like to do the same thing. Thank you once again for joining this, and thank you to NISM for hosting this.
I would like to extend our heartfelt thanks for taking the time to speak at our webinar. Your insights, expertise, and engaging presentation made a lasting impact on our audience. Thank you once again, sir, for sharing your time and knowledge with us. Wishing you a wonderful day ahead.